Hello friends, this is Denario Research and welcome to the sixth part of cryptocurrency trading tutorial. Today I'll speak about candlestick patterns and will show you some advanced configurations. Let's look again at long bullish and bearish candles. Long green candlestick shows strong buying pressure. The longer green candlestick is, the further the close is above the open, which is actually obvious. But this indicates that price advanced significantly from open to close and buyers were aggressive. While long green candlesticks are generally bullish, much depends on their position within a broader technical picture. After extended declines, long green candlesticks can mark a potential turning point or support level. If buying gets too aggressive after a long uptrend, it can lead to excessive bullishness. Long red candle shows strong selling pressure. The long red candlestick is, the further close is below the open, and this indicates that prices declined significantly from the open and sellers were too aggressive. After a long advance, a long red candlestick can foreshadow a turning point or mark a future resistance level. After a long decline, a long red candlestick can indicate panic sell or capitulation. Actually, I have mentioned two terms, support and resistance, which will be covered in the next video tutorial. The most important long candles are Marubozu brothers. Long green candle, sometimes called white Marubozu, and long red candle, sometimes called black Marubozu. The word Marubozu from Japanese means shaved head, and this is reflected in the candlestick's lack of wicks. Marubozu do not have upper or lower, as well here upper or lower shadows, and the high and lows are represented by open and close. A green Marubozu forms when an open equals to its low and a close equals to its high. And this indicates that buyers controlled the price action from the first trade here till the last trade here. Red Marubozu forms when open equals to its high and a close equals to its low. And as you guess, this indicates that sellers controlled price action from the first trade here until the last trade here. So, what does it mean on a trend? If we have uptrend and followed by green Marubozu, confirmed by volume, this means that bullishness is getting higher and more likely uptrend will continue. If green Marubozu occurs on a downtrend and is also confirmed by high volume, this means that bulls gained power over bears and trend reversal is most likely what will happen. If red Marubozu occurs on a downtrend and has high volume, so it indicates that bears have more control on the market and they cause it a panic sell by news or by some other ways, and most likely downtrend will continue. If red Marubozu occurs on an uptrend and also confirmed by high volume, in altcoin market it most likely means that pump is about to over and dump will start it soon. So trend reversal is most likely what will happen. Here are yet another two patterns, hammer and a hangman. A hammer is a bullish reversal pattern that forms only after a decline. It may have green as an example or red real body. In addition to a potential trend reversal, hammers can mark bottoms or support levels. So in our example it might be somewhere here, below the open price. After a decline, hammers signal a bullish revival. The long of the lower shadow implies that sellers drove prices lower during the session. However, a strong finish here indicates that buyers regained their footing to the end of the session on a strong note. While this may seem enough to act on, hammers require further bullish confirmation. The low of the hammer, so here, typically hammer has lows at twice in the size of the real body. The low indicates that plenty enough sellers still remain. Further buying pressure and preferably expanding volume is needed before acting. Such confirmation can come from a gap between hammer close and next candlestick open, or long green candlestick, and of course a high volume under the hammer. Well, hammers are similar to selling climaxes, and heavy volume can serve to reinforce the validity of the reversal. Hanneman is a bearish reversal pattern that can also mark a top or a resistance level, so it might be somewhere here. It may have a green or red as in our example real body. Lower shadow is typically twice larger than its real body. Forming after advance only, Hanneman signals that selling pressure is starting to increase. The low of the lower shadow confirms that seller pushed prices lower during the session. Even though the bulls regained their footing and rose prices higher by its end, the appearance of selling pressure raises a yellow flag. As with the hammer, Hanneman requires further bearish confirmation before acting. Such confirmation can come from a gap between Hanneman close and next candlestick open, or long red candlestick, and of course heavy volume under the pattern. The inverted hammer and shooting star look exactly alike, but have different implications based on a previous price action. Both candlesticks have small real bodies, they may be green or red, long upper shadows, here and here, small or as in our case, non-existent lower shadows. As other candlesticks, they mark potential trend reversal, but require confirmation before acting. The shooting star is a bearish reversal pattern that forms only on the uptrend in a star position. A shooting star can mark a potential trend reversal or resistance level, here. The candlestick forms when a price gaps higher previous candle, like here, on an open, then goes up to its high value and closes far below its high value. The resulting candlestick has a long upper shadow and small red as an example, or sometimes green real body. After a large price surge, which is reflected by a long upper shadow, the ability of bears to force price down gets stronger. And to indicate a substantial reversal, the upper shadow should be relatively long and at least twice larger than its real body. Bearish confirmation is required after the shooting star and can take form of a gap down between shooting star close and the next candlestick open, and of course long red candlestick and heavy volume. Shooting star is much robust bearish configuration than Hanneman because selling pressure is much higher. The inverted hammer pattern looks exactly like a shooting star but forms only after the downtrend. Inverted hammer represent a potential trend reversal or support level, somewhere here. After a decline, long upper shadow indicates high buying pressure during the session, so bulls were able to drive price from the here to here. However, bulls were not able to sustain this buying pressure, and price closed quite far from its high value, here. Because of this failure, bullish confirmation is required before action. An inverted hammer, followed by a gap between it where inverted hammer close and the next candlestick open, or long green candlestick on a heavy volume, can serve as a confirmation to open a long position. But inverted hammer is less robust bullish reversal pattern than hammer because buying pressure is much smaller in this case. Now you know the most frequent candlestick patterns. Of course there are many of them, and there is no need to memorize them all. If you understand the sentiment behind patterns I have talked about, you will easily recognize other patterns, even without knowing their names. This was all about candlestick patterns, and in the next video tutorial I will talk about support and resistance levels. Well, thumbs up if you like this video, subscribe to my channel if you want more videos, and leave your questions in the comment section below. Thanks for watching, bye!